Good afternoon, everybody, and welcome to Mecardo's Grain Market Outlook webinar. We appreciate the time you've taken to participate today. My name is Jenny Ann Hall, and I'm Mecardo's Business Development Manager, and I'm going to be facilitating the webinar today. Today, we have audio available via both telephone and computer. For those of you that are listening via your phone, please make sure that you mute your speakers on your computer. To do this, click on the speaker icon at the bottom of the webinar screen and make sure there is a small red cross against the speaker. That's just to avoid double up. If you're listening via your computer but find you have issues with the sound quality, please mute your speakers and then dial in using the 1-800 number and participant code that was on this screen now. For those of you who don't know, Mecardo is an online service providing analysis and commentary for livestock, wool and grain markets. Mecardo is provided by Ag Concepts Unlimited. There's an enormous amount of fantastic market information out there, and with Mecardo, we value add this information by filtering what's important, analysing it and delivering what's relevant to our subscribers. In particular, we focus on the market outlook and what the analysis means for the subscribers. Today, we're very pleased to have Chris Brown of CHS to talk about the state of the international grain markets and the outlook. Chris is Trading Manager at CHS, so welcome, Chris. Following Chris, Ag Concepts Unlimited's Senior Client Advisor and Market Analyst Angus Brown will take a look at the current basis in grain markets and what sales strategies might be suitable in the current environment. So welcome, Angus. Before we get underway, I've just got some brief housekeeping to outline. The webinar will run for 60 minutes and we'll have 15 minutes question time at the end. Because of the large number of participants, if you're listening via phone, your phone's been muted to make sure the quality of the audio is as high as possible. You can use the chat box at the bottom left of your screen at any time during the webinar to put forward questions. I'll collate these as we go and direct them to the presenters at the end of the session. Now, just to make sure you can ask questions if you need to, I would ask you all to go to the chat box at the bottom left of your screen, next to the little cog, and type in Y for yes or N for no to the following question. Are you listening to this webinar today via your computer's sound? I can see you all typing that, so that's terrific. Thanks very much. You can also use this chat section if you have any issues with accessing the webinar. Your chats will only be seen by the presenters and me and not the other participants. There'll be a short 1 to 2 minute survey at the end of the webinar. We would appreciate you remaining online for this, as your feedback really helps us to continue to improve our webinar service. And finally, if you have any technical issues, you can contact Redback Conferencing directly at any time by pressing *0 on your phone or dialing the 02 number there, and they'll be able to assist. Now, without any further delay, I'll hand over to Chris. Thanks, Chris.
Thanks, Jenny Ann. Welcome, everybody. Firstly, I'm just going to cover off on wheat and barley, but prior to getting into the detail of those commodities, and we'll address just the current market drivers and some of the pricing signals we're seeing that's relevant to each of those commodities. We'll just it's probably worth just giving a broad overview of, I guess, where we've come from at the start of this year, and why we've sort of arrived at these types of price levels, and I guess what the ongoing outlook is for the next season at least. So essentially, it's really it's a case of for the first time in a very long time we've seen large crops in both wheat, corn and soy, particularly in the US. So no doubt you've been getting plenty of information on where the current production levels are and world carryouts, but I guess it's just worthwhile noting where the carryouts are projected to this year and compared to last year, and it helps put it into perspective as to why when you hear commentators talking about the market, they're essentially using that term bearish outlook, and it's bearish because we're looking at large world carryouts due to a large world production, and we haven't seen a responding increase in demand to offset the increase in production. So essentially with wheat, the world carry-out numbers are projected to be 198 million tonnes, and that's up 14 from last year. In corn it's 188, which is up 16, and in soy it's 93.8, which is up 23, close to 24. So with those three major commodities all having to fire all at once and give us, decent world crops, it's essentially why we've got this backdrop of, a bearish outlook due to, large world supplies. And I guess if we look back over the last 4 or 5 years, it's kind of a delayed response to a structural shift in demand, if you like, where we saw, particularly the US with their ethanol mandate, which essentially increased the demand for corn, and obviously the world increases in demand for oils into the biodiesel programs. So essentially what we had this large increase, or a mandated increase in demand, and the US in particular struggled to keep up with that demand. Obviously we had specific seasonal conditions which stepped in and gave us sort of reduced corn crops and soybean crops. So the US had struggled to keep pace with this increase in demand. Now we've finally seen the required response in planting areas, and we've had the ideal seasonal conditions. So now we've got production that's overstepped demand, and we're really looking for obviously prices to move lower and take some acres out of the production system, or we're looking, I guess, in the longer term for perhaps an offsetting increase in demand. So the outlook, the broad outlook, yes, it's bearish, and I think it's fair to say it's also bearish, for at least another season. So until we start to get, our first look at Northern Hemisphere new crop production for the 15-16 season, or that's relevant for our 15-16, we would expect that the crop sizes that we're projecting, based on where prices are at the moment, cost of production, etc., we would still expect we're going to be dealing with, large supplies of particularly soybeans and corn. So I guess, with that as a backdrop, it's not an encouraging signal. But obviously, as we all know, production outlooks can change quickly, and seasonal conditions can certainly provide some surprises, which we obviously can't predict sitting here. So essentially, a bearish outlook, and certainly with what we're seeing at the moment, a bearish outlook for next season as well. So we would expect prices, general price levels, to basically move sideways for the remainder of this year. And I guess we would also expect, if we see the planting levels in soybeans and corn in particular in the US, where we're expecting them at the moment, we would probably expect in the first half of 2015 potentially there needs to be another move lower in those futures charts. So with that as the backdrop, then we'll just cover off on the three major commodities that are relevant to Australia. So essentially we'll move into what are the current price drivers for wheat, and what signals we're seeing at the moment, and what are some of the and what's our view on price. Aussie basis levels at the moment are extremely high, historically high, which is essentially driven by the low Chicago futures price, and Aussie values are essentially competitive into our main market, being Southeast Asia, compared to US wheat. The only origin that we do tend to lose out into Southeast Asia is Black Sea wheat, and it's not an exact science as to what that correlation should be, but Southeast Asian millers routinely tell us they like to see at least a $30 discount before they'll look to switch some of their demand into black sea wheat, and they can't switch 100% of their demand. Most millers tell us that at most they could probably look to blend up to 30% of black sea wheat with a good quality wheat like Australian wheat or US wheat. So essentially we're competitive with most origins into Southeast Asia. So I guess it's encouraging that the current grower bids that you're seeing in the market are essentially supported by by competitive origins into Southeast Asia. And we'll have a look at a few charts a few tables, which will talk a little bit more in detail about the parities. But I'll just run through the main points first, and then we'll brush over them. The other main factors we're looking at, particularly to Australian wheat, the USDA has still got Australia pegged in at 26 million tonne. So obviously when we started our production season, people were expecting a lot larger crop out of Australia, somewhere between that 24 to 26. Given the way the season's tailed off, I think most local commentators are calling the crop somewhere between 23 to 22 to 23. So essentially we've seen that, production outlook for Australia tail off. That helps to provide support to our basis levels, and while we're seeing reasonable strength in our prices. Obviously we've still got the domestic market and concerns of domestic coverage up and down the East Coast with the small crop in Queensland and the average size outlook for New South Wales. So that hasn't changed. A very similar pricing structure to what we looked at last year, where the East Coast was reflecting the domestic price and wasn't pricing into the export market. We've also got the take or pay structures, which are evident in the East Coast market with all the container packing capacity that we have, and we've also got a similar impact with the shipping slot logistics in both WA and SA. I'll just touch briefly on it, but essentially what it is, the take or pay type structure with the export logistics, you have to buy your shipping slots, which essentially creates what we refer to as a cost of forfeiture. So if you don't use that shipping slot, it's going to cost you a certain amount of dollars per metric tonne. So what that does, it does in some cases, in certain conditions, when there is not quite enough crop to go with the supply of export logistics, it tends to hold up the domestic price higher than where it should be to price into the export market. So an exporter might be faced with losing $20 a metric tonne on whether it be rail capacity or having bought an export shipping slot. So he's incentivised to try and reduce that loss if he doesn't use it. So he's incentivised to bid up the interior market up to within a few dollars of what he might lose if he doesn't use the capacity that he's bought. So that's where you see the domestic price invert above the export market. We're not at that situation in WA and SA. We are almost in that situation in SA. It's certainly reflecting some of that. WA's at this stage is more or less pricing what we term as cost of replacement into the export market. As far as recent tender activity or pricing activity signals that we can look at in the export market and relate back to Australian wheat, Iraq hasn't been decided yet, but we have seen where the prices have been offered into. We should get some word out of Iraq in the next, either today or tomorrow, and that will be instructive, particularly for Australian values. We were, I guess, broadly competitive with most other quality wheats. There was a couple of offers of Canadian wheat which were about $5 to $10 below Australian, but essentially it was quite a reasonable result, and it does provide a little bit of, I guess, comfort to us that the current values we're seeing in grower land are supported. Our view on prices, with all those factors in mind, is essentially neutral in the medium term, because I think we've got some support out of the domestic market on the East Coast. We've got some support out of us being competitive in the export market, and also these take or pay structures that are sort of resting below the market. So I think while we sort of grind through harvest, prices should be relatively supported, but I guess longer term we're bearish, and that's subject to seeing how Northern Hemisphere new crop plantings take off. If we move on to this, the next slide, Australian export values. This is essentially looking at each major port zone out of Australia and seeing how it prices into the export market. So the number I want to draw your attention to is this export parity number here, 278. So essentially, if we look at the grower bids in Western Australia at the moment, that's what they work out by the time you add your fobbing cost to it, converted into US dollar, it's essentially 278. So every other port zone out of Australia essentially has to trade at a discount to that to take into account the additional freight to move it up into Southeast Asia. So South Australia needs to trade somewhere between $4 to $5 below WA to land in at the equal values. So at the moment you'd say SA is overvalued by about $8 US in comparison to Western Australia. Moving to Victoria, you can see $13.99, so that's saying it's about $14 to $15. New South Wales, $16, and if you move into Queensland, $37. So those price signals there are telling you the prices you're seeing in Victoria, New South, and Queensland are driven off your domestic market, and they're not pricing into the export market. So essentially, as we addressed in that first slide, that's where the eastern states grow are getting their price support, and WASA, obviously firmly looking at the export values. This slide here essentially looks at its competitor analysis, so looking at the various origins and how they price into our main market, and that being Jakarta in Indonesia. So essentially what it does, it looks at that 275 FOB number, which is based out of basis Kwinana, adds the freight to it to get it up into Jakarta. So we can land wheat up to APW at 295, and then you look at the various origin, the ASW 290, and then you look at the other origins, so hard red winter out of the Gulf, hard red winter out of the PNW, soft white out of the PNW and Black Sea. And essentially that, this is, I guess, trading 101. We look at this most days to guide our pricing signals. So what we're taking out of this is APW, when you line it up against your hard red winters, clearly competitive. ASW, which is approximate for soft white winter wheat out of the PNW, we're also competitive there. So for the white milling type wheats into Southeast Asia, we're competitive. And it only gets a little bit questioned when you look at this Black Sea. And if you remember, the Southeast Asia, they can only use a certain proportion of that, and they need to see a $20, $30 discount. So essentially we're competitive into our main market, which is encouraging for Australian values. That's just a chart which essentially reflects the same things as table information, which you can look at your leisure. If we move on to canola, it's a little bit more of a confusing signal. Aussie values, while they're essentially competitive into our main market that's sending us the price signals, or has been sending us the price signals, is China. That's certainly where most of the business has been done to date. And at the moment, we're essentially competitive with Canadian. However, there's a couple of red flags to that analysis, which I'll cover off on as we move through. The general outlook for oilseeds is bearish due to the large soy crop. That's certainly the case. But one thing in support of canola is that oil stocks are fairly tight. So canola should gain some support this year and next year, despite the outlook for soy being bearish, from the higher oil share that canola enjoys. So I guess it's a slightly different subset within the oil sector. I guess the concern for Australian values at the moment, current grower bids, they aren't actually supported by recent Chinese bids. So essentially what we're saying there is, if you take the grower bid and add your bulk cost to it, the exact same analysis we looked at with the wheat, that's not pricing into China at the moment. Where Australia or Australian canola prices are getting their support in WA and SA at this stage is essentially out of exporters filling short. So exporters were putting on positions, at the start of the year as the values up over 500, 540 delivered into China. The current bid out of China at the moment is somewhere around 450, so there's been a huge move in that market. Currently where the grower bids are, they essentially do not calculate into the current Chinese bid. So I think we're going to see medium-term support while exporters cover short, but longer term, obviously the bearish outlook for new croppers is certainly evident. So just to run through that quick analysis. So at the moment, current grower bids is a day or two old, so may have changed with recent moves. That price is up at about 450. Current grower bids into China for 43.5 basis oil is around 455 to 460. So by the time you gross that number up, it does not actually calculate into China. So WA and SA lined up quite competitively there. So 450, 446. But yeah, essentially it's driven off a price where exporters are filling the short. Vic and New South Wales also looking relatively competitive in the export pathway, but we would expect to see some exports flow out of Victoria as well. Just a quick review on the analysis. We look at Aussie canola landed into China. Guangzhou is a major port up there. As I said, those recent value, current values we're looking at, they essentially landed at that 475, and current grower bids, or current Chinese bids rather, around that 455 CNF. So you can see our current values are well above where the Chinese would buy today. If you have a look at Canadian values, they're landing in at about 500. Aussie canola needs to trade at about a $15 discount for the Chinese to buy. So I guess we're essentially competitive in that regard, but basis where the Chinese are buying or where they're interested in putting on some new business, it's not actually calculating at the moment. Again, just a chart which you can look at your leisure. Moving on to barley. Aussie barley is a little bit different. I guess the world production numbers also reflect that. World carryout's projected to be 21.9, which is essentially stable from last year. Barley is one commodity out of Australia that's gaining good support out of China, and current grower bids are supported by where we're seeing Chinese buying demand at the moment. There have been some confusing signals in the corn market, which does tend to flow into the barley market. There's been and the soybean market has been meal shortages driven by logistical shorts more than anything in the US, and that has caused sort of recent rallies in corn, which has tended to impact barley prices moderately. But essentially the main pricing signal we're seeing is good, strong demand out of China for FAQ, and it's certainly supporting the price of the South Australian bids we're seeing in the market at the moment. So our view on price is neutral to sideways. There is some potential for support if China do need to take a bit more than what we would expect. Longer term, though, we would expect bearish in feed barley values due to the feed gluts that we're looking at for this year and carrying through to next year. So again, just a quick analysis of what we looked at with the other charts. This is not quite as a clear case. If you look at WA at the moment, a 247 track equivalent, that's 245. You would expect to see SA should be essentially a 240 type level. At the moment, it's 260. This number of 249 is pricing into China, and it's driven by, I guess, the perception that the SA barley should be a better FAQ type quality barley, which is what the Chinese are buying. So even though on paper you're looking like SA is $18 overvalued, it's not really reflecting the I guess the additional quality that I guess the trade is expecting to get out of the SA crop. So, but encouraging to note that I guess South Australia is probably the pricing point for export values into China, which is certainly the main market driving Australian barley values at the moment and providing good support. Again, just the CNF matrix to compare different origins. Again, it's a little bit unclear. I mean, if you're looking at December shipment here, straight away, I'd say Canadian's a lot cheaper landed in there. But essentially, when you look at this SA quality, it's a good quality FAQ, which malts Chinese are quite happy to malt that, whereas the Canadian's more of a feed grade wheat. So it's not really an accurate comparison like we looked at with the wheat. I guess, yeah, just in summing up, I guess really as we move through harvest over the three commodities, not expecting a lot of downside in either of the three majors. Would expect wheat, barley and canola to gain reasonable support during harvest. But I guess longer term, yeah, I think we need to have a good look at where Northern Hemisphere new crop plantings are lining up to give us direction for perhaps the next season. I think that's it from me on those commodities, so I'll hand you back to Jenny Ann.
Angus, we might just move in straight into yours, please.
No worries. Thanks, Jenny Ann. Thanks, Chris. That was very informative, and it leads well into what I'm going to talk about here, which is how do we use that information we've got from Chris and on their price outlooks and where our prices are sitting relative to the international job. How do we look at that, use that information in our marketing and sales strategies for the coming harvest? So this is our disclaimer. Obviously, this has to go on everything, so we're going to be making I'm going to be making some recommendations, but that doesn't necessarily mean they're going to be right and they're going to be right for you. So make sure you get some independent advice before you follow through on any of this. So we'll kick off today. I'm going to talk about domestic wheat supply. Chris touched on that earlier. We're going to have a bit of a look at basis, and we're talking a lot about basis. So just explanation of what it is. Historical and current basis levels. Harvest sales and hedging strategies. How we might structure that for the coming harvest, and for wheat, and then we'll do a similar thing for canola and barley. So this is just a chart showing Australian wheat production over the last 12 years, I guess. It's
Angus, can I just interrupt? Could you just please speak up a little bit, please?
Oh, okay. Sorry, Jenny. Yeah. You can see that over the last 5 or 6 years, we've had pretty good crops relative to the drought years of 2006, 7 and 7, 8. This year, you can see over there we're predicting in September that we're still up towards the 25 million tonne crop, which is what Chris was talking about. Since then, the weather has been about as bad as it could be for a lot of parts of the grain growing area on the east coast. It's been okay in the west, but the AEGIC put out a report recently forecasting where they think yields are going to be based on a very good report if you want to look it up, but that's based on rainfall, evaporation and these sort of figures, which gives you an estimated yield for each wheat growing shire in the country. And their forecast came in around the 21 to 22 million tonne level for Australia, and for the East Coast it's around 12 to 13 million tonne. The red line we've got on there, domestic consumption. So that's how much is used in Australia. On average, that number goes up and down. It'll probably be a bit higher this year with the amount of feed which is going to be consumed in some of the big livestock areas in southern Australia, which wasn't consumed last year. Obviously, there's been a lot going to southeast Queensland over the last 18 months, and that looks like it's going to continue for the short term at least. So the main point of this slide is you can see the East Coast production, which is big New South Wales, South Australia, and a little bit in Queensland for wheat, is still above the domestic consumption level. So there is going to be grain to export out of the East Coast. And as Chris said, what's driving the strong basis at the moment, or the strong premium for our prices relative to international prices, is the fact that is the shorts in the export market. So they need to chase that grain, which is pushing the prices up. And another point I will make on this is you can see we're still well above those levels of 2006-07 and 2007-08 and even 2002-03, which, while they were worse droughts, worse dry springs than the one we're currently having, some people are comparing the current spring to those times. So our wheat production is going to be well up on those. So basis. Basis is the difference between our local price. You can use any local price. We tend to use the ASX New South Wales wheat contract because it's a very transparent and easy to follow price, versus Chicago wheat, so Chicago soft red wheat. You can see here over the last 8 years, the blue bar is the Chicago wheat price, so an average harvest price. So that's we can see where that's been sitting. And the red bar sitting on top of it is the ASX basis. So that's the premium of our price over the Chicago price. Where the red bar is a negative, that's obviously years when basis has been low, when we've had big crops, little slower export demand, and our price is traded at a discount to the Chicago price. And obviously we've converted the Chicago price to an Aussie dollar a tonne value here. So basis is driven by local supply and demand influences. Chris touched on what those influences are at the moment, being Southeast Asian export markets and shipping issues here in Australia, which is what's driving this very strong basis here, which is, as you can see, equivalent to what we saw in 2006, which was a year when we didn't produce enough grain on the East Coast to supply the domestic market. So that's a bit of an indicator of just how strong the premium is here in Australia to the international benchmark of the Chicago soft red wheat contract. Here we're just looking at basis in another way. It's over time, so that's obviously the black line is the ASX New South Wales wheat, and the green line is Chicago. And you can see the periods there where we've had droughts in 2006-07, 2007-08, which is, let's get my drawing tool here and see if it works. Yeah, there we go. It's slow. So drought period, 7-8 drought period, 2010-11 was the wet harvest. So this is an APW contract, obviously, and that year we had a lot of downgraded wheat, so that we got a little bit of a similar situation now with a late harvest. There was obviously completely opposite ends of the scale, but with a late harvest, the supply of milling wheat was tight, and there was shipping slots to fill, so the APW price went to a good premium. The chart on the right is just the premium over time, so you can see where ASX has been at a strong premium to the Chicago in those drought / very wet periods. At the moment, we are at very high basis levels for a year where we're going to produce an exportable surplus, and Chris has explained why we're at those levels. So if you look at can basis increase? Well, probably not, or not a lot is the answer to that question. There are East Coast wheat prices over export parity. They're being driven by some domestic demand and shipping shorts, so basis risk is skewed to the downside. We don't think there will be a lot of downside in basis over harvest. It'll probably track around where it is. The things that could see basis ease would be a good general rain, which might take some of that feed demand out of the market. That's probably all that we'll see that might see a bit of downside, maybe some growers selling at harvest, but that's probably unlikely given what we've seen thus far for harvest. Growers are pretty happy to hold on and try and hold on to that strong basis level. So given basis is probably likely to go sideways, price rises can only come from the rising international market. So, we need to see the international price increase for us to see the local wheat price increase much further, which is the reason why holding physical wheat may be a risky proposition this year, because you're facing international market and basis downside. So the basis downside not huge, but there is little upside. So and the international market, well, that's obviously a 50-50. Something could go wrong somewhere and send prices higher, or crops could progress along pretty well, and we'll see prices steady or track lower. So this is just some strategies which might be an alternative to holding physical wheat. If physical wheat is a risky proposition, what else can we do? Well, if basis is strong, we often say, you're better off cashing your wheat. And if you do want to remain exposed to the market, and the only way prices are going to rise is through the international market rising, you can cash your wheat and buy swaps. It's opposite of selling swaps or selling futures. You buy them. If the market goes up, you make a profit. If the market goes down, you make a loss. But you're exposed to the physical market in exactly the same way. So exposed to the international market in the same way you are exposed if you're holding physical wheat. Except that you've got your money and you're obviously when the swaps or the futures close out, you either make a profit or a loss on that. Cash your physical wheat and buy call options. This is a very low risk strategy, which basically opens up the upside. So if the market rises, you'll be paid for every dollar it goes through whatever strike you put the call option at. So a call option is like a ceiling, a price ceiling. So if you buy Chicago, say July call options at $250 a tonne, the market goes to $255, you'll be paid $5 a tonne. The offset of that is you have to pay a premium up front. So like any insurance, you stump up the premium, which, depending on where you pitch your strike price and how far out you're going with your option, can be anywhere between $10 and $30 a tonne. So very low risk strategy, but also it comes at a cost. That's a good one when prices are relatively low, well, what they are at the moment, but the outlook is bearish, as Chris has said. So generally the market seems to think the international prices will fall, but it only takes they're talking about winter freeze in Russia and poor crop establishment, which could send the market higher in a hurry if it flows through to a 20-30% cut in Russian wheat supply. So that's where the potential upside in the international market might come from. So you take a call option, you will participate in that, but if the market does continue to track lower, you haven't lost anything but the premium. Storing physical wheat on farm, as I say, it's probably a reasonably risky strategy given where basis is and where and the international market outlook. So it might be worth thinking about taking some forward contracts which pay carry, pay you for storing it, you get your value for your storage and handling of $10 to $15, and you get your $2 to $50 to $3 a month storage, or ASX futures, which is basically the same thing. So you take an ASX futures contract, where the market falls, you'll be compensated. If the market rises, you have to pay money, but your wheat price will have risen. So you're no good year to be storing wheat thinking you're going to get a $20 rise, $20 to $30 rise post-harvest, and it's going to stay there. It's just, the risk is skewed to the downside, in our opinion. So if you're going to store wheat, you might want to think about taking some cover on a local market, not on an international market so much. So that's wheat. Barley, Chris has outlined, F1's expensive on the East Coast. You can see a chart here. I think feed barley futures today are at we're between 250 and 260. So that 250 is historically a pretty strong resistance level. They've really been through that, especially when you have a good, not a good crop, but a reasonable crop, an exploitable surplus, which we're going to have in barley, similar to the wheat situation. And it's also priced pretty well. Barley's priced pretty well relative to wheat. So that feed demand is really quite strong. The domestic feed demand is strong, and the export demand is relatively strong, which is holding up that feed barley price. I saw today the Geelong F1's quoted 267 today, delivered Geelong track market. So not Geelong, on the track market, 267, which is obviously a pretty strong premium to the futures. So the feed barley futures are now priced in New South Wales, where there's probably going to be relatively more grain. Geelong, Portland, Port zones, given what's happened in the last over the spring, with little rain, are going to be, might be short of feed, which is driving up those Geelong and Portland track markets. So again, upsides reliant on rising international values or local dry weather extending through the autumn. So the caveat to all this is that if you do hold on to feed grains or any grain, and we get this current dry spell extends through the autumn, the feed demand is going to remain consistent, and especially if people start to worry about next year's crop, as we've seen before, prices could rise further. The limit to how far they can rise is to international import parity, which is, depending on who you talk to, it's probably $60, $70, $80 away. That's as far as they can go, but they're not going to go there this year. They may, if we have a dry autumn and there's issues, worries about next year's crop being sown, then we could see a possible rise again, but the chances of that are probably pretty slim. Canola, again, where Chris touched on canola and how it's actually not very well priced into China at the moment. It's okay relative to Canadian, which is the ICE contract. Relative to European, it's at a premium to where it normally sits. It's obviously at a bit of a discount to the Metif contract, which is the French rapeseed contract, but it's at a smaller discount to what it usually is, and it's at a stronger premium to ICE than what it usually is. So again, there's probably some downside in canola if growers start to sell. Often we see canola the first thing to be sold, given it's a relatively high value and it can't be stored on farm. So, it can't be. It is rarely stored on farm. So there's a chance canola could come off relative to the international market. So again, it's unless you expect international markets to rise, and the head Chris is depending on the international oilseed complex, it's probably a reasonable sell at current levels of around 470 to 480 on the track market for Port on the track market. So barley and canola strategies, they're similar to wheat in that they're probably a pretty good sell at harvest or not long after harvest. And if you want to maintain exposure to upside, you would do that via some swaps or futures, by buying them or buying call options, which give you access to upside in that market without holding the physical, without impacting your cash flow. As far as your grain, you've got your cash, and then you buy derivatives to replace your grain. So it's a pretty tried and true strategy. It can work well, as long as the grower is aware that what they're risking, which is obviously if you're buying swaps, your risk is the market moves lower and you lose money. But it's exactly the same as holding on to physical grain. The market moves lower, you've got an opportunity cost of what you've lost. So in summary, local values are strong relative to international markets. No secret. there's not a lot of incentive to hold grain at current basis levels, except as a hedge against worsening local feed supplies. As I said, if the dry weather continues through next autumn, then we might see a lift in prices, local basis. Derivatives, and the main point of the presentation is to say derivatives can be used to access upside without holding the physical, without impacting your cash flow. So it is a relatively strategy is probably new to a lot of people, but it's pretty straightforward and can be easily implemented. Obviously, you need to get advice on how you do that from someone who's hopefully holding an AFSL. So you can hold your hands to it if you haven't done it before. But those who favour selling swaps, it's basically the opposite, and it's pretty straightforward. So that's it from me. So I'll hand back to Jenny Ann for questions.
No worries. Thanks, Angus. Now, I'd just like to open the floor for questions. So if you do have a question, could you please type it in the box down the bottom left of your screen next to the cog, and I'll direct them to the presenters accordingly. So we'll just wait a minute to give some people to ask questions if they have. I've got one here, and the question, probably perhaps directed at Angus, is it worth starting to think about hedging the 2015-16 crop? And if so, what would be the best hedging option for next year?
Good question, Jenny. Yeah, I think your 2015-16 wheat prices at the moment are on the Chicago around that 250 level, 250 to 255 probably. So that's not a great price historically, probably around average, around the 50th percentile. But having said that, if everywhere has a reasonable season, an average season, prices could easily go lower by the order of $40 to $50. So generally, our hedging strategy is to wait until after harvest. We've got plenty of grain to sell this harvest, and given that prices aren't at that magic $300 plus, probably waiting for the autumn to see if we see some issues in the world crop, which could add a bit of support to the market for that in that February-March period. That's when we'll be looking to price, and maybe have some targets around the 275, 280 level. Try and sell into that sort of wheat price rather than in the current one. I mean, options out that far are probably a bit expensive, and the other thing you could use physical local futures contracts, which are priced pretty well there. National dollar again, like the basis is quite strong, so that might be something you consider as well.
Okay, thanks, Angus. Chris, probably one directed for you in the first instance. And do you have any chickpea pricing views at all?
Chickpeas? No, I don't have any view on chickpeas at all. Certainly leave that to other traders that get more involved in the chickpea market. We don't trade chickpeas at CHS, and certainly don't have any experience in chickpeas.
Angus, have you got anything to add to that at all?
Very little, Jenny Ann.
Okay, that's all right. No worries. Okay, Angus, probably directed at you. Most domestic consumption for canola is on the East Coast. Are the crushers covered, and can this drive canola basis higher?
In a word, no.
Can you speak up, Angus, please?
Sorry. In a word, the answer is no. There's going to be enough canola produced on the East Coast to cover the crushers by a long way. I wrote an article on it for Mecardo about 2 or 3 weeks ago, which outlines the canola supply situation. Even if you cut New South Wales and Victoria production by 30%, we're still going to have to export 1 million tonnes or around that level. So it's basically canola basis probably won't be driven higher by local demand.
Okay, thanks. I'll actually send that article through to the participant that posed that question. Another question, any thoughts on wheat grade spreads in the export states? And is there some support for higher protein from export markets? Perhaps, Chris, could you answer that in the first instance?
Yeah, look, I think the grade spreads we're seeing currently in the export states are quite strong. but it certainly is taking the lead from US values. The dark northern spring wheats, DNSs, that are, I guess they're closest approximate to our wheats here, Australian prime hard. They are gaining good, strong price support out of the US because the really good, strong quality DNS is in short supply. So simplistically, yes, I think the protein spreads should remain well supported. Not sure whether we see any reason for them to rally any further from where the current levels at this stage.
Okay, thank you. I've just got one more question coming in, I think, but just so I can see it being typed. So while that's coming in, I just wanted to, on the screen now, you can actually see my contact details. If you've got any questions for either Chris or Angus, after the event, or if you'd like a copy of the slides, email me and let me know. We recorded the webinar today, so we'll also send you a link for the recording, but if you want the slides on top of that, just let me know. Okay, so just going back to the questions, got two questions. Perhaps Chris in the first instance, or maybe Angus, have you got any insights in relation to durum?
Yeah, I think durum is, again, it's a market that CHS globally are quite big players in. CHS, they own quite a lot of elevators in the US where durum's grown, and it's quite a big export trade out of the US. So, and we are involved in the market locally as well via GrainCorp. So durum prices well supported, and again due to, I guess, low supplies, particularly out of Australia. I think the outlook is, or the expectation is, there might be 100 to 150,000 metric tonnes available for the export market, and it's certainly in high demand. Current prices that have been seen up and down New South Wales, I think it's fair to say they are supported in the export market.
Okay, thank you. Chris, while you're on a roll, I've got one more for you. Feed barley has jumped $4 in WA today. Do you have any comments on that at all?
Well, I guess currency would be a bit of a contributor, but I think we're seeing a lot of strength in barley prices over the last 2 weeks in particular, and I think it's just growing confidence that the market is well supported into China. One point I probably didn't make clear enough in the barley presentation, while we are saying South Australia is really the export signal for barley at the moment in China, it really is a perception, and the perception is that the WA quality won't be as good as the South Australian quality due to the rains that were experienced a couple of weeks ago in WA, and also South Australian quality, traditionally better FAQ. So I guess in short, the jump in WA might be just I guess counteracting the additional support we've seen in South Australia, and perhaps a growing confidence that the quality coming in Western Australia is pretty good as well. Okay,
thanks, Chris. And we've got time for one last question directed at Angus. Are you able to? Who are the brokers in Victoria that growers can trade derivatives from? I mean, is that list a simple list, or is it should we be better off sending that to the participant that asked the question?
In the list, if you're not set up with your bank, who are the easiest one, there are a few brokers depending on your level of sophistication, who all the way from do-it-yourself online to hold your hand all the way through. So we can send a bit of a list of those out to that particular.
Okay, I'll organise that. Well, I think that's it in terms of the questions. So thanks very much for participating today. I hope you found it useful. And thanks very much, Chris and Angus, for taking the time to participate, both in the lead-up and today. And as always, it's much appreciated. I'm now just going to open a quick survey on the right. Give me 1 minute. I'd ask you, if you've got the time, to please take the time to complete this survey. As I mentioned at the outset, we value any feedback, and it just really helps us to make sure that we provide, a service that's relevant and useful to webinar participants. I'll leave that open now. Just another couple of things. We've recorded the webinar, as I said, and we will send you the link in the next day or so, as soon as it becomes available to us. And anyone on the session today that hasn't had experienced Mecardo before will also be set up with a 3-month free trial, and we'll contact you in the next couple of days of details on how you can access this. If you've completed your survey, this is it for the session today. So thanks again very much for participating, and hopefully we'll see you on future Mecardo webinars. Cheers.